Welcome back to the Deep Dive, your go-to source for cutting through the noise and really extracting the most important insights from complex topics.
Glad to be here.
Today, we're tackling, well, a truly intriguing puzzle. Imagine a company trying to fundamentally transform its very identity, its DNA. While the world around it, the market, the economy is just pulling it in 100 different directions. We've got a comprehensive investment analysis here that reveals a fascinating tightrope walk, honestly, full of unexpected complexities.
Yeah, it's precisely this kind of scenario that demands a deep dive, doesn't it? When a company is deliberately reshaping its core business model like this, traditional evaluation methods might not fully capture the new reality.
Or the new risks, I suppose.
Exactly, or the new risks. It forces us, and you, the listener, to look beyond the surface, beyond the headlines.
And the company we're diving into today is Colliers International Group, Inc., or CIGI. CIGI. Now, this isn't just another name you might find in, say, a real estate directory.
No, not at all.
CIGI is a truly global professional services and investment management firm. And they've got this fascinating, multifaceted approach to business. They've strategically diversified their operations.
Very strategic.
But that diversification, as we'll start to uncover, comes with its own unique set of questions, right?
Absolutely. So our mission today is to thoroughly navigate this comprehensive investment analysis of CIGI. We're going to dissect both the compelling opportunities that arise from its strategic pivots and the significant headwinds it currently faces. We'll extract the most important nuggets of knowledge and insight, helping you understand the core tensions at play and what truly matters for this evolving company.
So what is that central tension there? What's the core question this analysis puts right at the forefront for us? What are we wrestling with here?
It's a really fundamental query. You could almost call it a strategic wager the company is making. Is CIGI's aggressive diversification, its proven capabilities in mergers and acquisitions, M&A, and its sort of entrepreneurial culture, is that a durable competitive advantage?
Right.
Is it strong enough to allow the company to outperform even through sustained commercial real estate or CRE market stress?
Or the other side.
Or, conversely, do the relentless macroeconomic pressures, the inherent risks baked into its M&A strategy, and those persistent questions about earnings quality actually undermine its long-term value proposition? It truly is two sides of the same coin, each with very, very different implications for investors.
That dynamic tension, that push and pull, is going to be the thread guiding us through this entire deep dive, I think. It'll help us understand CIGI's journey. All right, let's get into it then. We're starting by simply unpacking Colliers International, a company in transformation. So what's the big story here? Let's start with the strategic evolution of CIGI. How has this company dramatically reshaped its identity?
Well, the core story is one of profound reorientation. CIGI has fundamentally evolved. It used to be, a very traditional CRE brokerage.
Right, selling and leasing buildings?
Pretty much. But now it's become a much more diversified global professional services and investment management firm. And this isn't just a minor tweak like adding a service line.
No.
No, the analysis really emphasizes that it's a strategic transformation. It's built on three distinct and now I'd say equally critical platforms.
Okay, what are they?
You've got real estate services, which is its traditional core, right? But then also engineering and investment management.
Engineering.
Yeah.
That seems like a bit of a leap from real estate brokerage.
It does at first glance, but it's key. The driving force behind all this, and this is critical for your understanding, is a deliberate strategy to, and I quote, mitigate the pronounced cyclicality inherent in the CRE transaction market.
Okay, so they're trying to smooth out the bumps.
Exactly. It's about building resilience into their very business model, making them less dependent on those sometimes wild swings in property deals.
Which, given the last few years, makes a whole lot of sense. So they're trying to future-proof themselves, or at least make themselves less vulnerable. Okay, now let's dive into the dual narrative. Bull versus bear investment thesis. There are always two sides. Let's start with the bull case. What's the positive spin?
The positive outlook for CIGI is largely anchored in that successful diversification we just talked about. And it's been powered by a very aggressive, yet, historically pretty effective acquisition-led strategy.
M&A.
M&A is central here. This approach has allowed them to build substantial, resilient, and crucially recurring revenue streams. especially within those newer segments, engineering and investment management.
Recurring revenue, that's the holy grail for smoothing things out, isn't it?
It absolutely is, and the numbers are quite striking here. The analysis states that over 70% of the company's earnings are now classified as recurring.
Wow, 70%.
Yeah. This provides a significant buffer against the inherent volatility of, transaction-based commissions in the traditional real estate side. Plus, you can't ignore the management track record. They boast a formidable 30-year history of delivering approximately 20% compound annual returns for shareholders.
20% compounded for 30 years. That's impressive.
It's a powerful argument for their disciplined capital allocation, no doubt. It tells investors, we know how to make money with your money.
Okay, that's a pretty strong set of arguments for the bulls. Impressive track record, recurring revenue. But then, as always, there's the other side of the coin. What does the bear case focus on? What are the worries?
Well, the negative outlook largely centers on the, frankly, difficult macroeconomic environment, particularly within the CRE sector itself.
Yeah, interest rates, uncertainty.
Exactly. Rapid monetary tightening has led to suppressed transaction volumes, big valuation question marks. Then you have structural issues, especially in the office sector. Hybrid work models are having a persistent long-term impact there.
It's not just a blip.
It doesn't seem to be. Furthermore, that very acquisitive growth model that fuels the bull case, it introduces its own set of significant execution and integration risks. Buying companies is one thing, making them work together smoothly is another.
Right, the integration challenge.
And perhaps most critically for investors, and something we'll definitely dig into, there's a persistent divergence between CIGI's strong adjusted or non-GAAP earnings and its weaker GAAP reported results.
The GAAP versus non-GAAP gap. That always raises eyebrows.
It does, and it raises valid questions about the underlying quality and sustainability of its profitability, which is a key concern for the bears. Is the reported profit the real profit?
Okay, so this is the central tension we're navigating throughout this deep dive.
No.
On one side, a transformed company, lots of recurring revenue, great track record. On the other, a challenging macro environment, M&A risks, and some, let's say, tricky financial nuances.
That's it in a nutshell.
How do we, as listeners, maybe potential investors, how do we approach this assessment? What's the key thing to grasp?
Well, I think the core insight here is that CIGI's valuation really hinges on whether its recurring revenue can consistently outgrow the costs and complexities of its M&A integration.
Okay, not just offset the cycles, but actually outgrow the costs.
Precisely. It's less about just riding market-wide tailwinds and more about a bet on management's execution skill. Can they keep integrating successfully and generating real profit from it?
So it forces you to ask.
It forces you to ask, does this transformed model genuinely warrant a premium valuation compared to maybe more traditional players? Or are the risks, the macro risks, the M&A risks, the earnings quality questions just too great right now?
And answering that requires really understanding each piece of the puzzle, doesn't it?
Exactly. We need to understand how each segment contributes or doesn't contribute to that overall picture.
All right, let's zoom in then. Let's get into the core of CIGI's operations and really understand its three pillars. We'll start with the first one, real estate services. The foundational business with a hybrid model. This is their traditional base, right? Offering services to CRE owners, occupiers, investors.
That's right. This is where they came from. And this segment is a perfect example of their hybrid model in action. It combines both transactional services and those recurring income streams we talked about.
Okay, break that down for us. Transactional first.
Sure. The transactional side includes commission-based services. Think capital markets, handling property sales, arranging debt finance, mortgage investment banking, and leasing representing both landlords and tenants in finding space.
Got it. The deal-making side.
Exactly. And these revenues are highly sensitive to the broader CRE market fundamentals, things like property values, vacancy rates, overall transaction volumes. If the market's hot, these divisions do well. If it freezes up,
they feel it quickly.
Yeah.
Like a weather vane, as you said.
Precisely. It reacts quickly to market shifts.
And we've got some illustrative data here from the analysis that really highlights that sensitivity, don't we? It shows it's not all moving in the same direction.
We do. It paints a clear picture. In the second quarter of 2025, for instance, their capital markets revenue showed a strong recovery. It grew 17% or 16% in local currency.
Okay, that sounds good.
Yeah, driven by activity primarily in the U.S., Western Europe, and interestingly, notable strength in debt finance, helping clients get loans in a tougher environment. But global leasing revenue told a different story. It actually declined 5%.
Declined. even with capital markets recovering.
Yeah. The analysis suggests this was impacted by macroeconomic uncertainties, particularly affecting industrial leasing, even though apparently there was robust growth in the office sector leasing, which is interesting in itself.
Wow. So even within the transactional side, you see different forces at play.
Absolutely. It's a clear demonstration of how different market conditions and sector-specific issues can impact specific subsegments within the same division.
So we're seeing this real-time reflection of market conditions, the good and the bad. But it's not all about those volatile transactions, is it? There's the other side you mentioned, the steadier part.
Exactly. And that's where their recurring and outsourced services come in. This is the ballast in the ship, so to speak.
Like what kind of services?
These include areas like property management, managing buildings for owners, valuation and advisory, telling clients what their properties are worth, and loan servicing, managing existing loans.
Okay, more predictable stuff.
Much more predictable. The key here is that these are typically governed by multi-year contracts. They generate stable, predictable fee revenue, almost like a subscription model for real estate services.
Right, steady income.
And this provides that crucial element of predictability to the segment's overall performance. For example, in that same Q2 2025, outsourcing revenues grew a steady 6% in local currency.
6%, okay. Not flashy, but steady.
Exactly, showcasing their resilience even when other parts of the business face headwinds. This recurring component is just a crucial element of predictability. It helps balance the inherent volatility of the transactional side, which again is absolutely vital for CIGI's overall strategy to mitigate that cyclicality.
Okay, pillar one. Real estate services, a mix of volatile deals and steady contracts. Let's turn to the second pillar, engineering, which the analysis calls an aggressive growth engine. That sounds different. What kind of services do they offer here?
This segment provides a truly wide range of multidiscipline engineering consulting and project management services. It's incredibly diverse.
Like what?
We're talking property and buildings, yes, but also transportation, big infrastructure projects, environmental consulting, power, utilities, serving both public sector clients like governments and private companies.
So much broader than just buildings.
Much broader. Their revenue generation is primarily through fees for professional services, usually on a project or contractual basis. And importantly, these contracts are often long-term, especially for those large-scale infrastructure projects.
Which again contributes to predictable revenue.
Exactly. It adds significantly to CIGI's base of predictable revenue. And the growth driver for this segment is quite clear. We've mentioned it before. Its dramatic expansion has been fueled by an aggressive acquisition strategy. This is the roll-up in action.
Here's where it gets really interesting. The engineering segment's growth numbers for Q2 2025 are truly eye-popping, a 67% surge. What does the analysis say about that?
Yeah, 67% or 65% in local currency, bringing revenues to $436 million in just one quarter. It's a staggering number.
What's behind it? Just acquisitions.
It's driven significantly by recent acquisitions, yes, but the analysis also mentions strong internal growth within the segment too, so it's a combination. But that huge headline number tells you something powerful about their strategy.
Which is?
That this substantial, largely inorganic growth is a direct reflection of the company's roll-up model firing on all cylinders. They are systematically acquiring smaller, specialized engineering firms, integrating them, and rapidly scaling up.
So it's a deliberate strategy
To diversify away from traditional real estate services and fundamentally reshape CIGI's overall earnings profile. It shows their M&A machine is incredibly active and, at least on the top line, very effective in this particular segment.
Okay, engineering. Fast growth, acquisition-fueled, diversifying the business. And finally, we come to the third pillar, investment management. This operates under the Harrison Street Asset Management brand, right? A well-known name.
Yes, Harrison Street is a significant player in its own right. This segment is a global investment manager focused specifically on alternative real assets.
Who are their clients, and what's their focus within alternative real assets?
They serve a very diverse client base. The analysis mentions over 900 institutional investors, think pension funds, endowments, and also more than 10,000 private wealth investors, so big institutions and high net worth individuals.
That's strategy.
Their investment strategy is quite focused. It targets sectors with strong demographic tailwinds and essential needs.
Like what specifically?
We're talking about areas like senior housing, student housing, healthcare facilities, life sciences buildings like labs, data centers, and critical infrastructure.
Things people need regardless of the economy, basically.
Pretty much. These are asset classes designed for resilient demand because they cater to fundamental, often non-discretionary needs. And that makes it a key part of CIGI's diversification play. It's another income stream less tied to the traditional property cycle.
So where does the revenue primarily come from for this Harrison Street segment? How predictable is it?
The primary stream is long-term recurring management fees. These are derived from the assets under management, or AUM. Basically, they get paid a percentage of the money they manage. And these assets are typically held in long-dated and perpetual funds, meaning the fee stream should be quite stable over time.
But not entirely stable.
Not entirely. The firm also earns transaction fees when they buy or sell properties for the funds, and, importantly, performance-based incentive fees, often called carried interest.
They carry. That can be lumpy, can't it?
Very lumpy. It depends on investment performance exceeding certain hurdles. So it can introduce a degree of volatility into the revenue stream. For example, in Q2 2025, the segment revenues were actually flat year over year.
Flat? Why?
It was impacted by the recognition of some large catch-up fees in the prior year quarter. So the comparison was tough. It just illustrates how performance fees can create that lumpiness in reported revenue from quarter to quarter.
And how big is this business? What's the AUM?
As of June 30th, 2025, their AUM reached $103.3 billion. And that number goes up to approximately $108 billion on a pro forma basis, meaning after accounting for the recent acquisition of Roundshield Partners.
Wow, over $100 billion under management. That's a huge amount of capital. And the demographic tailwinds and essential needs you mentioned for us, the listeners, what's the significance of that focus? Why does it matter for CIGI's long-term strategy?
The significance for you, the potential investor, is that focusing on these sectors points to potentially long-term resilient demand in these specific asset classes.
Awesome.
Well, think about it. People will always need places to live as they age or go to college, right? Healthcare services are generally non-negotiable, and the digital infrastructure data centers that powers our modern lives is only growing in importance.
So the demand is kind of baked in.
To a large extent, yes. This makes the investment management segment a key diversifier for CIGI. Its performance is less tied to the broad cyclicality of traditional commercial real estate offices, retail, and more linked to these fundamental, ongoing societal needs. It offers, hopefully, a steadier return profile over the long run. Tag 3, strategic evolution and geographic footprint.
Let's transition now. We've seen the pillars. Let's look at the bigger picture, strategic evolution and geographic footprint. We'll start with the strategic shift in earnings quality, a fundamental reshaping. The analysis states CIGI's evolution reflects a deliberate pivot away from over-reliance on cyclical CRE transaction revenues. They want a more balanced, resilient earnings profile.
This is a really critical point to grasp about CIGI today. The company's assertion that over 70% of its earnings are now recurring is the cornerstone of this entire strategy.
And is that just talk, or do the numbers back it up?
It's not just a narrative. The Q2 2025 results vividly show this in action. Remember, engineering revenue grew a staggering 67%.
Right.
While the more traditional leasing business actually contracted by 5%, this directly demonstrates how these stable, often recurring revenue lines from engineering and investment management are directly offsetting volatility in other areas, like transactional leasing.
So it's working as intended, at least in that quarter.
It appears so. It represents a fundamental reshaping of its financial DNA, a clear move towards more predictable income streams.
So what does this fundamental reshaping mean for your assessment of CIGI's valuation? If you're trying to figure out what this company is worth, how should you be thinking about this shift?
Well, the implications for valuation are potentially profound. This reshaping suggests the market may, over time, increasingly value CIGI less like a pure-play CRE brokerage, which typically gets lower multiples.
Exactly. And more like a diversified business services firm, or perhaps even closer to an asset management firm, which often command higher valuation multiples.
A re-rating, basically.
Potentially, yes. If this shift proves durable and profitable, it could lead to a structural re-rating of its valuation multiples over the long term. Therefore, for you, focusing solely on traditional CRE metrics like leasing spreads, transaction volumes is just no longer sufficient.
You need a broader lens.
Absolutely.
Okay.
A thorough analysis must now weigh things like engineering project backlogs, AUM inflows in the investment management arm, and fee-related earnings margins with equal or maybe even greater importance. You have to broaden your analytical toolkit significantly.
That's a really important shift in perspective for anyone analyzing CIGI. Now let's talk geography. Global reach with a U.S. anchor. They operate globally, Americas, EMEA, Asia-Pacific. But the data reveals a notable geographic concentration, doesn't it? It does. While they are genuinely a global player, their revenue base shows a very clear concentration in the Americas. The analysis cites 2019 data, for example, where the Americas accounted for 56% of global revenues.
Over half.
And within that, the United States specifically was the single largest market, contributing 42% of total global revenue.
42% is from the U.S.
Right. So this concentration means that despite all its service line diversification, the engineering, the investment management, CIGI's overall performance is still disproportionately exposed to the economic health and, crucially, the monetary policy environment of the United States.
So if the U.S. sneezes,
CIGI could still catch a cold, exactly. A significant downturn in the U.S. economy would still have a very material impact across their operations, even with the diversification efforts in other areas. It's a key risk factor to keep in mind.
Okay, let's widen the lens again and talk about the broader environment CIGI operates in, navigating the real estate tides. Industry dynamics. We're looking at the current state of the CRE services industry for 2024-2025. The analysis describes it as a period of tentative, almost fragile recovery.
Yeah, I think fragile is a good word for it. The CRE market is navigating a really complex period. It's emerging from significant disruption caused by that aggressive monetary tightening by central banks around the world.
We're seeing some stability now.
Some signs, yes, especially after the Federal Reserve started signaling and then making rate cuts in late 2024. But uncertainty definitely persists. Transaction volumes, which had really fallen off a cliff, are beginning to recover, but, and this is important, from a very low base. It's like starting from the bottom of a well.
Do we have numbers on that recovery?
Yeah, the analysis gives an example. In Q2 2025, national U.S. CRE transaction volume reached $115 billion. Now, that was a modest 3.8% increase year over year.
3.8%. That doesn't sound like a roaring comeback.
Exactly. It signals a tentative recovery, but certainly not yet robust. It's more like, as I said, slowly dipping a toe back into the water rather than diving in head first.
And you mentioned earlier, it's clear the CRE market isn't a monolith. Different sectors are telling very different stories. Can you give us a quick breakdown of that divergence by property type? What's relatively hot, what's decidedly not?
Absolutely. We see really distinct performances across the board. Industrial and logistics, think warehouses, remains a relative bright spot, still supported by e-commerce, supply chain shifts.
Still strong.
Relatively strong, yes, but the momentum has slowed. Rent growth, for instance, decelerated significantly from over 7% down to just over 2% by the end of 2024. So still growing, but not like it was.
Okay, what else?
Retail has been surprisingly resilient, especially grocery-anchored centers. Vacancy rates are tight, consistently below 5%. Seems people still need to go out and buy milk and bread in person.
Some things don't change. What about apartments? Multifamily?
Multifamily demand is fundamentally strong. People need places to live. But some Sunbelt markets in the U.S. are facing overbuilding issues. Too many new apartments came online at once,
Leading
to rising vacancy rates and landlords having to offer concessions like a month's free rent to fill units. So some softness there in specific areas.
And then the elephant in the room, office.
And then there's office, arguably the most challenged sector by far. National office vacancy hit a record high of 20.4% in the first quarter of 2025.
20% vacant, wow.
Yeah. Largely due to the structural, ongoing impact of hybrid work.
Yeah.
It's a truly bifurcated market with massive challenges for older buildings especially.
That's a stark picture. Now let's dig into the enduring impact of the interest rate environment. The analysis really hammers home that interest rates are the single most important cyclical driver for CRE. Why are they so critical?
They truly are. You can think of interest rates as kind of the gravity of the financial world, especially for assets like real estate that rely heavily on debt. The sharp increases we saw through 2022 and 2023 significantly raised capital costs for developers and investors. It made financing much more difficult and expensive. And it essentially froze transaction activity because it created this wide bid-ask spread.
Buyers and sellers couldn't agree on price.
Exactly. It's hard to agree on a price when the cost of borrowing money is changing so rapidly and going up so much. So the Federal Reserve's pivot towards rate reductions in late 2024, that was a crucial positive catalyst.
Why? Just the lower rates.
Not just the lower rates themselves, but the signal it sent. It helps restore some liquidity and confidence by suggesting that the peak in financing costs had likely passed. People could start making deals again with a bit more certainty.
But we're not going back to the boom times, are we?
No, the general outlook now is for a higher for longer rate environment compared to the ultra low rates we had before. This means a return to the frenetic transaction volumes of, say, 2021 is pretty improbable.
Like expecting a marathon runner to sprint the whole race.
Exactly, just not sustainable or likely over the long haul. And this fundamentally changes the financing landscape. It places a premium on firms like CIGI that have sophisticated capital markets advisory and, especially, debt placement capabilities. They need to help clients navigate more complex financing structures in this new reality.
And CGI seems to be positioned for that, right?
Yeah.
You mentioned their Q2 2025 capital markets revenue grew 17%, and they specifically called out strength in debt finance. Sounds like they're adapting.
That's right. That growth in debt finance specifically indicates they are adept at assisting clients in this higher for longer environment. When traditional property sales are slower, helping clients secure new debt or refinance existing loans becomes a critical, highly valued skill. They found a way to add value even when deal volume was lower.
Let's move on to remote work trends and office utilization. A structural shift. It sounds like hybrid work isn't just a temporary blip caused by the pandemic, but a fundamental, lasting challenge for the office sector.
It's absolutely looking like a structural challenge, not merely cyclical. Widespread hybrid work policies have led to persistently lower physical office utilization, even if companies still lease the space. And that translates into those record-high vacancy rates we talked about, 20.4%.
But is it affecting all office buildings equally?
No, not at all. Within this difficult environment, a distinct flight quality has emerged. Tenants are prioritizing newer, high-quality, amenity-rich buildings.
Why?
To attract employees back to the office, basically, to make the commute worthwhile. This creates a bifurcated market, a huge split between the desirable modern buildings and the older, less appealing ones.
So the best buildings are still doing okay.
Relatively okay, yes.
Yeah.
The analysis gives examples. Prime office vacancy was exceptionally low in certain desirable submarkets, like Dallas's Preston Center at 3.9%, or Midtown Manhattan at 6.8% in Q2 2025. That contrasts sharply with the high national average. It's almost like a luxury car dealership in a struggling economy, only the best, newest models are moving easily.
So this is both a threat and an opportunity for a company like CIGI, isn't it? The overall decline in leasing is a direct headwind. We saw their Q2 2025 global leasing revenue dropped 5%.
Correct. That's the direct negative impact.
But the flight to quality must create opportunities for them in other areas, right?
Yeah.
It's not all downside.
It certainly does create opportunities. The need for landlords to reposition or retrofit older properties to compete, coupled with tenant demand for advice on finding the right kind of space to attract workers back.
That generates work for CIGI.
Exactly. It creates significant demand for advisory services, project management for renovations, valuation expertise, and general consulting. CIGI's ability to capture this advisory work is a critical factor in potentially offsetting the broader weakness in overall office leasing volumes. It's about adapting their service offerings to the evolving needs of the market, finding that silver lining in a challenging cloud.
Finally, in this section, let's look at CIGI's niche in a giant's game. Colliers is a significant player, no doubt, but it operates at a smaller scale than the real behemoths like CBRE Group and Jones Lang LaSalle. How do they carve out their space against those giants?
That's an important distinction to make. While CIGI is substantial, the analysis pegs their 2024 revenue at $4.8 billion. It's really dwarfed by CBRE's $35.8 billion and JLL's $23.4 billion in the same year.
Huge difference.
Massive. CIGI's scale is actually more comparable to Cushman & Wakefield, which generated $9.4 billion in 2024. So CIGI's competitive strategy isn't about competing on sheer size or trying to be the biggest fish in the pond.
What is it?
Instead, its differentiation comes from its structure. Its substantial and rapidly growing engineering and investment management platforms distinguish it from peers, who are typically much more heavily weighted toward traditional real estate services like brokerage and property management.
So the diversification is their niche.
In many ways, yes. This unique three-pillar structure positions CIGI as a more diversified professional services firm overall. It uses its real estate expertise as one of several core pillars, rather than as its sole foundation. They're playing a slightly different game than the pure-play real estate giants.
Now, let's turn our attention to competing and growing. CIGI's differentiators and risks. We just talked about CIGI's scale compared to the giants. So let's start by really outlining the competitive landscape. The primary competitors are truly formidable players.
They really are. You've got CBRE Group, the world's largest, reporting that massive $35.8 billion in revenue in 2024. Then Jones Lang LaSalle, or JLL, the second largest, at $23.4 billion. And Cushman & Wakefield, also a significant global player, at $9.4 billion.
These are global powerhouses. They have vast networks, deep client relationships.
Absolutely. They have scale, strong brand recognition, and often very entrenched relationships with major corporations and investors worldwide. It's a tough field to compete in.
So against these formidable players, how does Colliers carve out its space and manage to grow? What are CIGI's key competitive advantages? Where do they really shine, according to this analysis?
Well, the analysis points to several crucial differentiators that allow them to compete effectively, even without the same scale. First, and maybe most importantly, is that diversified three-pillar business model we keep coming back to.
The engineering and investment management parts.
Exactly. That substantial engineering presence, in particular, provides a large, growing revenue stream that is not directly correlated with the ups and downs of the CRE cycle. It acts as a kind of natural hedge, offering greater earning stability than maybe some peers have.
Okay, diversification is number one. What else?
Second, they boast an entrepreneurial and decentralized culture. Management really emphasizes its enterprising culture and this unique partnership philosophy. They grant significant autonomy to local leaders.
Why is that an advantage?
It can be very attractive for attracting and retaining top professionals, star brokers, engineers, advisors who might prefer a less centralized, maybe more agile structure than what some of the larger, more bureaucratic competitors offer. Gives them more freedom to operate.
Makes sense. What's number three?
Third, there's significant insider ownership. This is quite notable at CIGI. The global chairman and CEO, J.S. Hennick in particular, owns a substantial stake in the company.
So his interests are aligned with shareholders.
Very much so. This creates a powerful alignment with long-term shareholders. It fosters an owner's mindset and a focus on enduring value creation rather than just hitting quarterly targets, because their personal wealth is deeply intertwined with the company's long-term success.
Okay, diversification, culture, insider ownership. And the fourth advantage is something we've definitely touched on already. Their proven M&A platform and roll-up strategy. This seems absolutely central to their growth engine.
It is absolutely critical. You could argue this is a core competency for them, maybe the core competency driving growth. They have a well-documented history over decades of acquiring smaller, often privately held firms in fragmented markets like engineering or specific real estate service niches.
And the goal is
To build scale rapidly and expand their capabilities, this has been the primary engine of growth, especially for that booming engineering platform, and it's a key part of their 30-year track record of value creation.
You mentioned multiple arbitrage earlier. Can you explain that again? How does buying small firms create value?
Sure. So multiple arbitrage works like this. CIGI, as a larger public company, generally trades at a certain valuation, multiple, say, a multiple of its earnings or EBITDA. They then acquire smaller private firms. These private firms often sell for lower valuation multiples because they're smaller, less liquid, maybe family-owned. By acquiring these lower multiple private firms and integrating their earnings into CIGI's larger, higher multiple public entity, you effectively get an uplift in value almost immediately. The market values those same earnings more highly once they're part of CIGI.
So buying $1 of earnings at a 5x multiple and having the market value it at 10x once it's inside CIGI.
That's the basic idea, yes. It's a powerful wealth creation tool if you can execute it well. It requires identifying the right targets, paying the right price, and, crucially, integrating them successfully. It's a difficult skill to master consistently, and the analysis suggests Colliers has proven quite adept at it over a long period.
It sounds like a powerful engine for growth, definitely. But the analysis is also very clear that this strategy is a dual-edged sword. It carries substantial risks. It calls the M&A-driven roll-up strategy fraught with significant risks that are central to the bear case. What are these specific risks we need to understand?
You're right. It's a high-stakes game, and the risks are very real. The analysis highlights several, but the most critical one is probably integration risk.
Making the acquired companies actually work together.
Exactly. Successfully merging disparate corporate cultures, different IT systems, varied operational processes, it's notoriously difficult. If they get it wrong, it can lead to the loss of key talent from the acquired firm, the very people they bought the company for.
Right. The founders or star engineers leave.
Precisely. It can cause disruption to client service during the transition and ultimately a failure to realize the projected synergies, the cost savings or revenue growth they expected. In the worst case, it destroys value rather than creating it.
Okay, integration is number one. What else?
Another major risk is the temptation to overpay for assets, especially when lots of buyers are chasing deals in a hot sector, like engineering consulting has been. Overpaying erodes or eliminates that multiple arbitrage benefit we just discussed. You have to maintain discipline.
And the third risk.
And finally, this strategy is often debt-fueled. Buying companies costs money, and often that money is borrowed. This leads to higher financial leverage on the balance sheet.
And we have some data that shows this elevated leverage at CIGI compared to peers, right?
Oh, we do. The analysis points out that CIGI's net debt to EBITDA ratio, a key measure of leverage, was 2.3 times at the end of Q2 2025.
How does that compare?
It's notably higher than its larger peers. JLL was mentioned at 1.2x and CBRE at 1.47x around the same time.
So significantly more debt relative to earnings.
Yes. And this represents a key financial vulnerability. It makes them more sensitive to earnings declines or rising interest costs. So for you, the investor, putting it all together, an investment in Colliers is fundamentally a bet on management's continued ability to skillfully execute this complex, multifaceted roll-up strategy.
It's a bet on execution.
It really is. And this means it's critical for you to monitor metrics beyond just simple headline revenue growth. You need to watch things like margin trends in the engineering segment after acquisitions happen. Are the margins holding up or declining? You need to watch employee retention rates in acquired firms. And crucially, you need to look at the return on invested capital, or ROIC, that's actually being generated from these M&A activities to truly assess if they're creating sustainable long-term value.
Okay, let's dive deeper into the numbers themselves now. Let's move into financial performance and growth history. We'll start with revenue growth, the M&A engine versus organic reality. On the surface, CIGI has shown really impressive consolidated revenue growth, hasn't it? Largely fueled by that M&A engine we just discussed.
That's right. The headline numbers look strong, no question. Consolidated revenues grew significantly from approximately $2.8 billion back in 2020 up to $4.8 billion in 2024.
That's a big jump in 4 years.
It is. It represents a double-digit compound annual growth rate, or CAGR. And this momentum continued into the first half of 2025. Q2 2025 saw revenues increase by a robust 18% year over year, hitting $1.35 billion.
18% growth. Sounds fantastic.
Looking at that number in isolation, you might think the company is just growing explosively across the board, organically firing on all cylinders.
Okay, let's unpack this then. 18% sounds great, but why is the organic number so much lower? And what does that really tell us about the underlying health of the business?
This is a crucial distinction, and it gets right to the heart of the business's intrinsic health, separate from the acquisitions. The company's consolidated internal or organic revenue growth for that same Q2 2025 was actually a much more modest 4% in local currency.
8% compared to 18. That's a huge gap.
It is a significant gap, and it starkly quantifies the company's dependence on M&A to drive its overall top-line expansion. While acquisitions are a legitimate and often effective part of their stated strategy, a sustained low single-digit organic growth rate, like 4%, could potentially signal some underlying weakness in its core operations. Or maybe a lack of those cross-selling synergies they hope for from the diversified platform. Are the different parts really helping each other grow?
So for us, the listeners, this is a key metric to watch.
Absolutely. It's a key metric to monitor closely as an indicator of the company's intrinsic health, beyond just the sugar rush you get from M&A. How well is the existing business growing on its own?
That makes the distinction between what they're buying and what they're actually growing internally much clearer.
Okay, next up, let's look at profitability. The GAAP versus non-GAAP chasm. This is the gap you mentioned earlier. On an adjusted basis, using non-GAAP metrics, adjusted EBITDA has shown strong growth, tracking that headline revenue.
Indeed, adjusted EBITDA, that's earnings before interest, taxes, depreciation, and amortization, a common measure of operating performance, it increased substantially from around $390 million in 2020 to $644 million in 2024, tracking the revenue growth.
Right. And in Q2 2025, adjusted EBITDA grew 16% year over year to $180.2 million. So the adjusted profit picture looks pretty rosy following the top line.
Right.
But GAAP results, the generally accepted accounting principles results that follow stricter accounting rules, they tell a very different and for some investors a much more concerning story. Very different. In that same second quarter of 2025, where adjusted EBITDA was up 16%, GAAP operating earnings actually declined to $99.2 million from $114.7 million in the prior year. Decline. And GAAP diluted net earnings per share, the bottom line profit attributable to each shareholder, fell sharply, really sharply, to just 0.08 cents. 8 cents from 0.73 cents, 73 cents in the prior year quarter.
Wow. From 73 cents down to 8 cents on a GAAP basis, while adjusted EBITDA is up 16%. That's a massive difference. What explains this chasm, as the analysis calls it, and what's the critical insight here for an investor trying to understand profitability?
It is a huge difference, and this substantial and persistent divergence is a really significant analytical concern for anyone looking at CIGI. The adjustments that bridge the gap between GAAP and non-GAAP typically include items like
Things they add back,
exactly. Like the amortization of intangible assets that arise from acquisitions, things like brand value or customer relationships they paid for. Also, restructuring costs associated with integrating those acquisitions, and often other items deemed non-recurring.
Okay, so costs related to the M&A strategy mostly.
Largely, yes. While these kinds of adjustments are common in highly acquisitive companies, a large and growing gap like this, quarter after quarter, year after year, it can obscure the true economic profitability and the actual cash-generating capacity of the business.
How so?
Because it suggests that the costs associated with their M&A strategy, both the tangible restructuring costs and the non-cash amortization costs, are substantial and ongoing, not just one-offs. The critical insight here for you, the investor, is that while CIGI shows impressive adjusted growth,
And the number they highlight.
the number they prefer to highlight, understandably, this persistent chasm means a significant portion of that growth isn't translating into reported GAAP profitability that fully benefits shareholders under standard accounting rules.
So it forces you to question.
It forces you to question the true quality of their earnings. How sustainable is this adjusted profit if the GAAP profit is so much lower? What is the real underlying economic profit of their M&A strategy after accounting for all the costs, cash and non-cash?
It's like the staging versus the inspection report again.
Exactly. Adjusted earnings can be like the beautifully staged house for sale, showing all the potential upgrades and the future vision. GAAP earnings are often more like the detailed home inspection report, revealing the underlying costs, the necessary repairs, the realities of getting there. Both perspectives have truth, but they paint very different pictures of profitability. And understanding that difference is key to the bear case against CIGI.
Okay, very clear. Now, turning to the balance sheet and financial flexibility. We know CIGI maintains a leveraged balance sheet, which is a direct result of funding that M&A strategy. What does that leverage actually look like on paper?
That's correct. The M&A drives the leverage. As of December 31st, 2024, the analysis shows the company reported total debt of $1.51 billion. That was against shareholders' equity of $1.33 billion. So more debt than equity at that point.
And the key ratio, net debt to adjusted EBITDA.
Right. That net debt to adjusted EBITDA ratio stood at 2.0 times at the end of 2024. And it actually increased to 2.3 times by the end of Q2 2025, mainly due to recent acquisition activity.
And how does 2.3x compare again?
As we mentioned, this level of leverage is notably higher than its larger peers like CBRE around 1.5x and JLL around 1.2x. This introduces a greater degree of financial risk, particularly if earnings were to weaken in an economic downturn or if interest rates were to climb significantly higher again. More debt means less wiggle room.
So they're clearly taking on debt for growth. That's the strategy. But the analysis also suggests they have the financial flexibility to keep moving forward despite that leverage. How do they manage that balancing act? How do they keep the M&A engine fueled?
That's a key point. Despite the elevated leverage, CIGI appears to have maintained considerable financial flexibility. The analysis notes they entered 2025 with over $1.2 billion in available liquidity.
Liquidity meaning cash and available credit.
Exactly. Cash on hand plus undrawn amounts on their credit facilities. And this liquidity position was actually bolstered by a $300 million equity offering they did back in February 2024.
Selling new shares.
Right, selling new shares to raise cash. And they also expanded their main credit facility. So this substantial liquidity provides them with a war chest, so to speak, for further acquisitions and strategic investments. It allows them to continue executing their growth strategy even with those elevated debt levels. They are highly focused on maintaining access to capital to keep feeding that M&A machine.
Okay, let's round out this numbers section with cash flow generation and returns. A look beneath the surface. Their asset-light business model, they don't own lots of buildings themselves, seems to generate strong cash flow. Is that right?
It does, generally speaking. As a professional services and investment management firm, they don't have huge capital expenditure requirements like, say, a manufacturing company. For the full year 2024, Colliers generated $330.2 million in free cash flow.
Free cash flow being the cash left over after running the business and making necessary investments.
Exactly. And management also reported an impressive 98% free cash flow conversion rate from their adjusted net earnings on a trailing 12-month basis in Q2 2025.
98% conversion. That sounds very efficient.
It is. It indicates very efficient working capital management and suggests that those adjusted earnings, while different from GAAP, are actually converting well into cash. This robust cash flow is critical because, as we've said, it's the lifeblood of their capital allocation strategy. It primarily fuels their M&A activities. They generate cash. They use it to buy more companies.
Okay, strong cash flow. But then there's this fascinating discrepancy when it comes to returns on that invested capital. Management claims they achieve over 15% return on invested capital, ROIC, on their acquisitions.
That's their internal target and what they often highlight.
Yeah, the analysis cites third-party data reporting a much more modest consolidated ROIC for the entire company of only 5.10% on a trailing 12-month basis. And return on equity, ROE, was 9.24%. That's a pretty wide gap between the 15% target and the 5% actual consolidated return.
It is a very significant discrepancy, and it's definitely something you, the investor, should scrutinize carefully. ROIC, remember, measures how efficiently a company is using all its capital, debt, and equity to generate profits. ROE measures profit per dollar of just the shareholders' equity.
So why the gap? Why 15% on deals but only 5% overall?
This gap suggests that while individual acquisitions might meet that 15% ROIC hurdle at the time of the deal, based on projected synergies and standalone performance, the consolidated return on capital for the entire enterprise, once everything is mixed together, is substantially lower.
What could cause that?
It could be due to several factors. Maybe lower returns from their original organic business lines are dragging down the average. Perhaps the dilutive effect of corporate overhead costs isn't fully allocated to the deals initially. Or it could point to persistent challenges in achieving those projected post-acquisition synergies across the entire complex organization. Maybe the integration isn't yielding the expected profit boost overall.
So for us,
For you, it underscores the importance of looking beyond management's targeted metrics for individual deals. You need to analyze the actual consolidated returns the company generates on its total invested capital base. It paints a more complete and perhaps more sobering picture of the company's overall capital efficiency and the true value creation from that M&A strategy.
okay, let's look forward now. Enough dissecting the past. Let's explore fueling future growth. Opportunities and strategic initiatives. It's clearly not just about acquisitions, right? The analysis points to key organic growth drivers beyond buying companies. What are they trying to cultivate from within?
Exactly. While M&A is undeniably a dominant part of their story and growth engine, CIGI is also focused on cultivating growth organically from the businesses they already own.
How? What's the main lever?
A primary strategic rationale for having that three-pillar platform in the first place is the potential for cross-selling integrated services. That's a big one.
Meaning selling engineering services to real estate clients or vice versa.
Precisely. The idea is to leverage the client relationships they have in one segment across the others. For example, an engineering client undertaking a big project might then need property management or valuation services from the real estate division once it's built. Or an investment management client might leverage CIGI's brokerage capabilities to buy or sell properties for their fund.
Makes sense in theory. Does it work in practice?
That's the key question for you, the investor. Is this truly synergistic in practice? Is it consistently translating into measurable, incremental organic growth? Or are the divisions still operating somewhat in silos? The analysis suggests this is a key area to watch for proof points.
Okay, cross-selling is one hope. What are some other organic drivers they're focused on?
They're also actively pursuing penetration of new markets and channels, trying to expand their addressable market.
Any examples?
A clear example mentioned is within their investment management segment, Harrison Street. The rebranding and expansion of a previous acquisition versus capital into Harrison Street Private Wealth is a strategic move.
Aimed at who?
Aimed squarely at penetrating the large and growing high net worth investor channel. This segment has historically been somewhat underserved by institutional-grade alternative asset managers like Harrison Street. It's a smart play to tap into new pools of capital beyond just the giant pension funds.
Okay, new channels. What else?
Thirdly, CIGI aims to capitalize on powerful secular tailwinds, long-term trends that should benefit their business regardless of short-term cycles.
Where do they see those tailwinds?
Their engineering segment is positioned to benefit from expected global spending on things like infrastructure modernization, sustainable energy initiatives, the energy transition, and continued urbanization trends. Big societal shifts requiring engineering expertise.
And investment management.
Similarly, their investment management segment through Harrison Street focuses on those demographic-driven and needs-based asset classes. We discussed student housing, senior housing, life sciences, data centers. All are expected to have resilient demand driven by long-term trends like aging populations, growth in higher education, and digitization. They're trying to surf these long-term waves, not just the short-term ripples.
So it's not just about buying growth. They're also trying to cultivate it from within by being smart about where they focus their existing businesses and how they connect them. Now let's revisit the M&A machine. Strategy and integration capabilities. We know acquisitions remain CIGI's primary growth engine and a core competency of the management team.
That's definitely a key takeaway from the analysis. Their strategy consistently focuses on acquiring smaller, often complementary firms in fragmented markets. The goal is always to build scale and add new capabilities quickly.
Can you give us examples of recent major acquisitions that illustrate this?
Sure. The analysis highlights a couple of significant recent deals. In engineering, the acquisition of Englobe for $475 million in July 2024 was a major move. It significantly scaled up that platform, adding substantial expertise, particularly in infrastructure and environmental sectors in Canada and Europe.
Nearly $500 million. That's big.
It's a substantial bet. And in investment management, they acquired a majority stake in Round Shield Partners. This is a European credit platform managing about $5.4 billion in AUM.
What did that add?
It expanded Harrison Street's reach into the European credit market, which is a growing area, and also enhanced its expertise in specific sectors like student housing and hospitality lending in Europe. These aren't small tuck-in deals, they're strategically significant moves to build out the platforms.
But, as we've hammered home, integration is the critical factor here. It's where the value is either created or destroyed. What specifically about their integration capabilities should we or investors be watching closely?
Absolutely. Integration is make or break. The company often touts its decentralized operating model as a way to facilitate integration. The theory is that by allowing acquired leadership teams to retain a degree of autonomy,
They don't scare off the talent.
right, the hope is it reduces culture clash and helps keep the key people who made the acquired company successful in the first place. However, the financial and operational success of these integrations, do they actually hit the profit targets? Do the teams work well together? That remains the key variable. It's what will ultimately determine the long-term value created by this M&A-centric approach.
So for us watching from the outside,
For you, it's about watching for signs. Do these acquisitions truly create measurable value over time, improved margins, faster organic growth, successful cross-selling? Or do integration challenges lead to things like key talent departures, client dissatisfaction, maybe even write-downs later on? That's the risk. The proof, as they say, is in the post-acquisition pudding, usually visible over the next couple of years after a deal closes.
okay, finally in this section, let's touch on technology investments and digital transformation. Is this a strength or potentially a potential gap for CIGI? Management says they prioritize investing in IT and technology.
They do say that. They describe their approach as pragmatic and tailored. The focus seems to be on using technology to provide clients with better insights, data analytics, market intelligence, and also to streamline their own internal processes, making them more efficient.
But how does that compare to their giant competitors? Are they keeping pace?
Well, this is where a potential question arises. When you compare CIGI's public messaging and perhaps their strategic focus on technology, it appears somewhat less pronounced than some of its largest competitors.
Like who?
For example, JLL has gone so far as to establish a dedicated JLL Technologies business segment. They heavily market proprietary AI-driven platforms like something called JLL Falcon and even JLL GPT. They're making technology a very visible part of their brand and value proposition.
And CIGI isn't doing that as much.
Their public emphasis seems less overt. Now, this doesn't necessarily mean they aren't investing, but it presents a potential competitive risk down the road if technology and advanced data analytics become increasingly critical differentiators in the delivery of real estate and investment services. If clients start demanding more sophisticated tech platforms,
CIGI might be perceived as lagging.
potentially. For you, assessing this risk would require digging deeper. Comparing CIGI's actual capital expenditures on technology and maybe their R&D spending relative to peers might help determine if a competitive gap truly exists and if it could hinder their ability to keep pace in the future tech-driven landscape of professional services. It's an area to watch.
Let's shift gears now and discuss capital allocation and shareholder returns. How does CIGI use the money it generates? Starting with management's capital allocation priorities, the analysis says it's clearly M&A first. Reinvestment for growth seems to trump everything else.
That's absolutely the case. It's not even subtle. Their capital allocation is clearly and decisively prioritized toward reinvestment for future growth, and that primarily means funding their ongoing M&A strategies.
What's the evidence for that?
The evidence is clear in their financial actions, not just their words. In 2024, remember, CIGI raised $287 million through that equity offering.
Selling shares.
And almost immediately deployed $475 million more than they raised to acquire Globe. That shows the priority. The Q2 2025 earnings call further highlighted a robust pipeline of potential M&A deals and stressed ongoing investment needs for the Harrison Street platform.
So the cash flow they generate goes right back out the door for deals.
Pretty much. Their ability to generate that strong free cash flow with the high conversion rate we talked about provides the financial capacity to constantly fuel this reinvestment-focused strategy. They're essentially funneling almost all available capital back into the business, mostly via acquisitions, to expand.
So they're not just talking about growth, they're putting their money, literally, where their mouth is to achieve it through M&A. But this intense focus on reinvestment must mean that dividend policy and share repurchase programs take a back seat, right? What does that mean for an investor looking for income?
Precisely. If M&A is priority number one, something else has to be lower down the list. CIGI does pay a semi-annual cash dividend, but the yield is minimal. The analysis pegs it around 0.18% on a trailing 12-month basis. Tiny. Basically negligible.
Practically, yes. This very low yield clearly signifies that the stock is not managed to attract income-oriented investors. If you need regular dividend checks, CIGI is probably not the stock for you.
What about buybacks? Buying back their own shares?
They do have a program. They announced a normal course issuer bid, which is the Canadian equivalent of a share repurchase program, back in May 2025. However, buybacks appear to be a much lower priority for CIGI compared to some peers, like JLL, which has been more aggressive in repurchasing shares recently.
So dividends are tiny, buybacks are modest.
Correct. This clearly underlines their strong preference for external growth through M&A over returning capital directly to shareholders in the short term via dividends or significant buybacks. For you, the investor, it's a clear choice. You are choosing potential future growth over immediate yield with CIGI. This all boils down, then, to management's track record of value creation. This seems to be the implicit shareholder pact, as the analysis calls it. The core justification for prioritizing reinvestment over dividends is management's exceptional long-term track record, that figure of approximately 20% compound annual investment returns over 3 decades.
Right. That impressive long-term track record is presented, effectively, as compelling evidence that the capital they reinvest back into the business consistently generates superior returns compared to what shareholders might get if they received the cash as dividends and invested it themselves.
So the pact is, trust us, we can grow your money faster.
Essentially, yes. It establishes this pact with investors. An investment in CIGI represents an implicit endorsement of the specific capital allocation philosophy. You, the investor, are being asked to forego higher immediate cash returns, bigger dividends, more buybacks, and the belief that this reinvested capital, primarily through M&A, will compound at a superior rate over the long term,
leading to greater capital appreciation in the stock price down the road.
That's the expectation. It's a very clear trade-off. You sacrifice short-term income for the potential of higher long-term growth. And it's a decision you consciously make when you choose to invest in this particular company, trusting management's ability to continue delivering on that 20% promise or something close to it.
Let's reflect briefly on the recent past now, looking at navigating the storm. Recent challenges in CIGI's response, specifically during that very turbulent 2022-2024 period. We know the impact of rising interest rates on CRE markets had a chilling effect across the board.
It absolutely did. That rapid and aggressive tightening of monetary policy by the Fed and other central banks dramatically increased debt costs for commercial real estate. As we discussed, it caused transaction volumes to just plummet as that wide valuation gap emerged between buyers and sellers. Nobody knew what things were worth or what financing would cost next week.
How did CIGI experience this directly?
This directly impacted CIGI's crucial capital markets business, the part that handles property sales and financing. While Q2 2025 did show that 17% year-over-year rebound in capital markets revenue.
Which sounded good.
It sounded good, but it's crucial to remember, as the analysis points out, this was coming off a very, very low base from the depths of the freeze in 2023-2024. And significantly, management's own 2025 outlook explicitly remains contingent on lower interest rate volatility.
So they're still nervous about rates.
It shows they acknowledge the continued sensitivity of this core business line to monetary conditions. They're still keenly watching the Fed and hoping for stability, if not further cuts.
Okay, so rates were a huge headwind. But beyond that, there was also significant office market disruption and economic uncertainty, creating headwinds from multiple directions, wasn't there?
That's right. It wasn't just interest rates. The structural disruption from hybrid work continued to hammer the office sector, leading to those rising vacancy rates and downward pressure on rents. We saw the impact in CIGI's numbers. Q2 2025 saw that 5% decline in global leasing revenue overall.
But there was a nuance there, wasn't there? It wasn't just office weakness.
Yes, interestingly, the press release initially attributed that overall leasing decline primarily to tariff-driven uncertainties, especially in industrial leasing. This apparently more than offset what they described in the earnings call as robust growth, specifically in office leasing in that quarter.
Wait, office leasing grew robustly, but overall leasing declined. That's confusing.
It is a bit confusing, but it highlights the complexity. It suggests that while they might have done well perhaps signing deals for high-quality office space, the flight to quality, the weakness in other areas, like industrial leasing possibly impacted by global trade worries and tariffs, was significant enough to pull the whole segment down.
So it underscores that it wasn't just office woes or interest rates.
Exactly.
Yeah.
Broader macroeconomic concerns like global trade uncertainty and tariffs were also playing a role, impacting other sectors like industrial leasing. CIGI consistently identifies global trade uncertainty as a key risk factor, and this seems to bear that out. It was truly a multi-front battle for them during that period.
So it sounds like they weren't just battling interest rates and hybrid work, but also these global trade tensions hitting specific sectors. Given all that, how did management's strategic response and adaptation play out during this challenging 2022-2024 period? How did they cope?
Well, this period arguably provided a real-world stress test for CIGI's diversification strategy. And in some key areas, the strategy seemed to work as designed. They leaned heavily into it.
How so?
The standout performance of the engineering segment, remember that explosive 67% revenue growth in Q2 2025, driven by acquisitions made during the downturn, that was a crucial stabilizing force. It directly offset weakness in the more cyclical transactional real estate businesses.
The diversification hedge worked.
It appeared to, yes. Within the real estate services segment itself, they focused on their more resilient services. That steady 6% growth in outsourcing revenues, things like property management, valuation demonstrated stability, even as leasing struggled. And within the volatile capital markets division, their specific focus on debt finance targeted a key client need in that difficult financing environment.
So adapting within the segments too. What about investment management?
In investment management, Harrison Street, the strategy during the turmoil involved continued fundraising, gathering capital from investors, and importantly, preparing to deploy its approximately $8 billion in dry powder.
Dry powder meaning cash ready to invest.
Exactly. Cash ready to invest. The idea was to be positioned to acquire assets at potentially attractive lower valuations in a dislocated market when others might be forced sellers or hesitant buyers, playing offense when others were retreating.
So looking back, this period really tested their model.
It absolutely did. And it showed that the diversification strategy, particularly the large engineering and investment management platforms, could act as a powerful offset during periods of significant market stress in traditional real estate. It allowed them to navigate the storm better than perhaps a pure-play brokerage might have. #HagX, leadership, vision, and corporate governance.
Let's turn our attention now to the people steering the ship. Let's delve into leadership, vision, and corporate governance. Starting with the leadership team, the analysis suggests there's a lot of stability and experience at the very top of CIGI.
Absolutely, that comes through clearly. J.S. Hennick stands out. He's the global chairman and CEO, but also the founder and the controlling shareholder of the company. He's really the architect of CIGI's entire 30-plus year strategy.
And his track record.
That 20% compound annual return figure over 3 decades is largely attributed to his leadership. Plus, his significant personal equity stake ensures that powerful alignment with long-term shareholder interests we talked about. He wins when shareholders win.
Who else is key?
Christian Mayer, the CFO, is also highlighted. He has a very long tenure, having been with the company or its predecessors since 1999. That provides deep institutional knowledge and continuity in the crucial finance function. And Elias Mulamudal, the Chief Investment Officer, CIO, is central to their M&A growth strategy, responsible for overseeing global investment activities and strategic acquisitions.
So this isn't a company with revolving doors at the top. It's led by a stable, experienced team with really deep roots in the business itself.
That seems to be the case, and that kind of continuity can be a real strength, especially for a company pursuing a complex long-term strategy heavily reliant on disciplined M&A execution.
And that leads directly into their strategic vision and execution. Does the analysis suggest they have a clear path forward and they're sticking to it?
Yes, the message is that CIGI's strategic vision is remarkably clear and has been very consistent over time. Transform the company into a more resilient, diversified professional services and investment management firm with a high proportion of recurring revenue.
It's not a moving target.
Doesn't appear to be. And the analysis suggests they're backing it up with action. The rapid growth we've seen in the engineering and investment management segments, the increasing percentage of recurring earnings in their overall mix, and the continuous pace of strategic acquisitions all provide tangible evidence that management is effectively executing its stated plan. They seem to be consistently walking the talk.
Okay, stable leadership, clear vision, consistent execution on the strategy. Now, regarding corporate governance practices, the analysis mentions there are some nuances for investors to be aware of, particularly related to their status as a foreign private issuer. What does that mean?
This is an important detail for you, the investor, especially if you're primarily familiar with U.S. corporate governance standards. Because CIGI is a Canadian corporation, even though it's listed on a U.S. exchange like the NASDAQ.
It's considered foreign.
Yes, it qualifies as a foreign private issuer under U.S. securities laws. This status exempts it from certain NASDAQ corporate governance rules, things like board composition requirements or shareholder approval rules for certain actions, provided it complies with its home country, Canadian practices instead.
Do they disclose the differences?
Yes, they are required to disclose how their Canadian practices differ from NASDAQ rules, so it's transparent. But it means you, as a shareholder, might see some differences in board structure or shareholder rights compared to a typical U.S. company. It's just something to be aware of.
And the other key governance point is the controlling shareholder.
Right. The presence of Jay Hennick as a controlling shareholder due to his ownership stake is a double-edged sword from a governance perspective.
How so?
On the one hand, it provides that long-term strategic vision and stability we talked about. It insulates the company from short-term pressures from activist investors who might push for different strategies. He can focus on the long game.
But the downside?
The downside is that minority shareholders have very limited ability to influence major corporate decisions if the controlling shareholder disagrees. Your vote doesn't carry the same weight. So an investment in the company is, in many ways, an implicit endorsement of his leadership and strategic vision. You're betting on him as much as the company. It's a trade-off. You get stability and long-term focus, but less shareholder influence. Hashtag XEI, valuation analysis and risk assessment.
Okay, let's move into the critical area of valuation analysis and risk assessment. How much is CIGI worth and what could go wrong? First, valuation analysis. Interpreting the multiples. We touched on this, but the historical trading ranges for CIGI can look a bit complex and sometimes downright misleading, can't they?
They certainly can, especially when you're dealing with a company undergoing transformation and operating in a cyclical industry like commercial real estate. It makes point-in-time valuation tricky.
So that price-to-earnings ratio, the PE.
Right. The trailing PE ratio, that's the current stock price compared to the company's actual reported GAAP earnings over the past year, it often appears significantly elevated for CIGR. The analysis mentions ranges like 73x to 77x.
Which sounds incredibly expensive.
It does. But this is largely distorted by those temporarily depressed GAAP earnings we discussed earlier, the result of the cyclical downturn combined with acquisition-related amortization and restructuring expenses hitting the GAAP bottom line.
So trailing PE isn't very helpful here.
probably not the most helpful metric on its own. A potentially more reasonable metric to look at is the forward PE, which is based on analysts' estimates for future earnings. That sits in a much more conventional range, mentioned as 24x to 26x.
Okay, 24, 26x forward PE. What about other metrics like EBITDA?
The enterprise value to EBITDA, or EBITDA ratio, that's a metric that gives a clear picture of a company's total value, including debt, relative to its operating profit, and it's often preferred for acquisitive companies that's reported in the range of 16x to 19x on a trailing basis.
16 to 19 times. How does that stack up relative to peers? Is CIGI considered cheap, expensive, or fairly valued compared to CBRE, JLL, Cushman & Wakefield?
Well, based on that forward PE of approximately 25x, CIGI trades at a noticeable premium to Cushman & Wakefield, which was cited around 12x. But it's roughly in line with the other giants, CBRE at around 24x and JLL at around 27x.
So more expensive than Cushman, similar to CBRE and JLL. How do bulls and bears justify this?
The bull case, naturally, argues that CIGI's premium valuation, compared to Cushman at least, is justified. They'd point to CIGI's historically higher growth rate, largely driven by M&A, and its more resilient, diversified business model with that higher percentage of recurring revenue from engineering and investment management. They argue it should trade at a higher multiple because it's a fundamentally less cyclical, higher growth business now.
And the bears.
The bear case counters that this premium is completely unjustified. They'd point to the significant M&A execution risks we've discussed, the company's higher financial leverage compared to peers, and crucially, that persistent gap versus non-GAAP earnings gap. They argue these factors introduce more uncertainty and risk, which doesn't warrant a premium valuation, maybe even calls for a discount.
And considering the cyclical nature of real estate, we also need to think about cyclical valuation adjustments. It feels like trying to value something on a roller coaster.
Exactly. Point-in-time metrics, whether it's PE or EBITDA, can be really misleading in a cyclical industry like CRE, especially when you're near a trough or just beginning a recovery.
Why?
Because current or trailing earnings are likely still suppressed from the downturn, making valuation multiples look artificially high just because the ease in the ratio is low. The market is currently in the early stages of recovery from the 2023-2024 trough.
So looking forward is better.
Looking at forward-looking multiples based on expected earnings recovery can be more reliable, or even trying to calculate cyclically adjusted PE ratios, averaging earnings over a full business cycle, maybe 5-7 years, to smooth out the peaks and troughs. For you, the listener, the key is to interpret these varying metrics carefully, always considering the stage of the economic cycle and not just taking a single snapshot number at face value.
Okay, that's valuation. Now let's talk explicitly about the downside. Let's do a comprehensive risk assessment. What could go wrong? We've touched on many of these, but let's consolidate. What's the most significant overarching risk here? The big cloud hanging over CIGI.
Without a doubt, the most significant overarching risk remains economic cyclicality and market conditions. CIGI's performance, even with all its diversification efforts, remains highly sensitive to general economic conditions, global interest rate movements, and the overall health of commercial real estate markets worldwide. A deep recession or another unexpected spike in interest rates would negatively impact all segments, some more than others. That's the big external risk.
And the biggest internal or company-specific risk?
The analysis is clear. The most critical company-specific risk is M&A execution and integration risk. Because acquisitions are their primary growth driver and core strategy, a major failure here, a deal that goes badly wrong, an integration that fails could be disastrous.
Also.
It could lead to those cultural clashes we talked about, key talent walking out the door, disruption to client relationships, significant financial write-downs if they overpaid, and ultimately a severe loss of investor confidence in management's core competency. This is where the rubber really meets the road for their strategy.
Okay, market cycles and M&A integration are top risks. We also discussed their financial leverage, which is higher than peers. Remind us of the dangers there.
Yes, that elevated net leverage ratio, currently around 2.3x adjusted EBITDA, makes them inherently more vulnerable if their earnings were to decline significantly. It also makes them more sensitive to higher interest costs on their debt. In a severe downturn, there's an increased risk of potentially breaching debt covenants, which could trigger defaults or force them to raise capital at unfavorable terms. It just reduces their financial cushion.
What other risks does the analysis highlight?
Several others. There's dependence on key personnel. Like any professional services firm, their success relies heavily on attracting and retaining talented professionals. The star brokers, the expert engineers, the savvy investment managers. High turnover would hurt them badly.
Makes sense.
Then there's geographic concentration. We mentioned that majority of revenue coming from the Americas, particularly the U.S., exposes them disproportionately to the specific economic and regulatory environment in the United States. Currency and foreign exchange risk is also a factor, as nearly half, 46% of their revenues come from outside the U.S., meaning reported financials are subject to fluctuations in exchange rates when they translate those earnings back into U.S. dollars.
Any others?
Yes. The analysis also lists standard operational risks like cybersecurity and IT system risks. A major disruption, security failure, or cyber incident could lead to business interruption, financial loss, and significant reputational damage. And finally, ESG and climate-related risks are increasingly relevant.
How do those apply?
Both transition risks, like potential costs from carbon pricing regulations or changing client preferences towards greener buildings, and physical risks like climate-related damage, floods, storms, impacting properties they manage or advise on. For you, the investor, understanding this whole constellation of risks is not just an academic exercise. They represent real, tangible vulnerabilities that could significantly impact investment outcomes.
All right, we've looked at the past, the present, the risks. As we look to the road ahead for CIGI, let's first identify some potential positive catalysts. What could happen to really boost the company and its stock? What are the indicators that things are moving strongly in the right direction?
Well, a major positive, perhaps the biggest external one, would be an accelerated decline in interest rates. If the Fed or other central banks cut rates faster or further than currently expected, that would likely significantly boost CRE transaction volumes and breathe a lot more life into the capital markets and leasing businesses. That would be a huge tailwind.
Okay, lower rates help a lot. What else internally?
Internally, a major accretive acquisition could be a catalyst. If they announce a large, strategically sound acquisition, one that clearly strengthens a platform or adds significant earnings, and it's well received by the market, that could lead to a positive re-rating of the stock. It would validate their M&A prowess again.
What about organic growth?
That's another key one. Clear evidence of stronger organic growth. If they could demonstrate a sustained acceleration in that internal revenue growth rate, getting it consistently above the current modest 4% level, that would be very positive. It would signal success in cross-selling, less reliance on M&A, and show the underlying business is truly thriving on its own.
And for investment management.
Successful fundraising in investment management would be a big plus, specifically achieving or exceeding their stated target of raising $5 billion to $8 billion annually for Harrison Street. More AUM directly translates into higher predictable management fee revenue, which investors love for its stability.
Okay, so lower rates, good M&A, better organic growth, strong fundraising. These are the key events that could really light a fire under CIGI stock and validate their transformation strategy. But conversely, what are the potential negative catalysts? What could drag CIGI down? What are the specific red flags we should be watching for?
On the flip side, the most significant negative external catalyst would be an economic recession or a hard landing, particularly if it hits the U.S. hard, given their revenue concentration. A significant deterioration of the global economy could freeze CRE markets again and severely impact revenues, especially in their cyclical businesses.
And internal missteps.
M&A integration problems or a major strategic misstep would be very damaging. If there were public issues with a major acquisition, key talent leaving en masse, publicly missed financial targets for the acquired unit, or if they simply made a strategically flawed deal that the market hates that could severely damage management's credibility and the stock price.
What else operationally?
A stalled recovery in transactional businesses. If their leasing and capital markets divisions fail to show continued recovery beyond the current tentative rebound, maybe even slip backwards, that would be a major red flag. It might suggest a more prolonged structural downturn rather than just a cyclical dip they can ride out.
And the balance sheet?
Rising leverage. If we saw a significant increase in their net leverage ratio, maybe due to underperforming acquisitions or slowing earnings without corresponding profit growth, that could raise serious concerns about their debt sustainability and their capacity to continue funding future acquisitions. It might force them to slow down the M&A machine. For you, these are the key potential negatives, the red flags to watch for that could signal trouble ahead for CIGI.
So given all these potential positives and negatives, what are the absolutely key metrics and indicators to monitor? If you want to keep a pulse on Colliers International, what should be on your watch list?
Okay, for you tracking CIGI, here's a short list of essentials. First, probably most important for judging the core business, the internal organic revenue growth rate. Is the existing business growing on its own?
Got it. What else?
Second, watch the segment-level adjusted EBITDA margins, especially in the engineering segment following major acquisitions. Are they maintaining or improving profitability as they integrate, or are margins getting squeezed?
Okay, organic growth, margins.
Leverage.
Definitely. The net debt adjusted EBITDA ratio. Keep a close eye on this to monitor financial risk and also their capacity for future acquisitions. Is it trending up or down?
What about the investment management side?
For Harrison Street, the key metrics are AUM net flows, is more money coming in than going out, and fee-related earnings, FRE, which is the stable management fee revenue minus operating expenses. That's a better measure of underlying profitability than total segment revenue, which can be lumpy.
And that GAAP versus non-GAAP issue. Absolutely critical to keep monitoring the spread between GAAP and non-GAAP earnings. Is that gap widening or narrowing? A narrowing gap might suggest better earnings quality or fewer large adjustments, while a widening gap reinforces the bear case concerns.
Okay, great list. Consider these your essential tools, everyone, for keeping a pulse on Colliers International as it continues to navigate its complex transformation. #tag outro. Wow, what a journey we've really been on today, unpacking Colliers International Group, Inc. We've seen this company evolve, haven't we? From a, fairly traditional CRE firm into this highly diversified global professional services and investment management powerhouse.
It's really a significant shift.
It's not just a slight adjustment. It's a truly profound strategic pivot. And they're doing it all while navigating a really turbulent economic landscape. It's just a compelling story, that tension between their growth ambition and the inherent, ever-present risks.
It really is. And it's a testament to how companies have to adapt and evolve, especially when their core industries are undergoing major structural shifts, like commercial real estate is with hybrid work and changing capital markets.
So understanding CIGI isn't just about this one company, is it?
Not at all. It serves as a powerful case study for you, the listener. A case study in the complexities of M&A-driven growth, the challenges of integration, and the crucial, sometimes confusing distinction between reported GAAP financial metrics and the adjusted non-GAAP numbers that companies often prefer to highlight.
Right. These are insights and questions that you can apply far beyond just CIGI, really, to many other firms pursuing aggressive growth or transformation strategies.
Absolutely. The patterns and the analytical questions are very relevant elsewhere.
Indeed. So let's end with a final provocative thought for you to chew on as you go about your day. Could Colliers International's aggressive diversification and M&A strategy, even with its apparent high risks and that notable GAAP versus non-GAAP earnings chasm, could it actually become the definitive playbook for navigating turbulent, cyclical industries in the 21st century? Is this how you build resilience now?
Or does the inherent complexity, the high leverage, and that heavy reliance on non-GAAP metrics perhaps mask a more fragile reality, a reality that investors need to constantly scrutinize with a very critical eye?
It's a real question, isn't it? About the nature of sustainable value creation in an ever-changing complex market. What does long-term success really look like for a company like this?
It's a question that definitely challenges the traditional definitions and demands a thoughtful, critical approach from every single investor trying to understand these evolving business models.
Couldn't agree more. We encourage you, our listeners, to keep these insights and questions in mind as you encounter similar stories of corporate evolution, and to always explore beyond the surface-level numbers.
Keep digging deeper.
Thanks so much for joining us on this deep dive. We'll catch you next time.